What's up, you guys? So Web here from OneGlanceTrader.com, and in this video I'll be walking you guys through how you can make passive income weekly while you're holding a losing stock position. Now, wrap your head around that for a second. Imagine that you had shares in a company at $100 and it's currently trading at $80, so you've got a 20% unrealized loss. Most people would either sell off their shares or hold those shares until it recovers back to its original position. But with the power of selling options and in particular selling covered calls, you can still make income while you're holding that losing position. And that's what we're going to go through today. And we're going to use a live example of ChargePoint holdings, and we'll go through everything about what the position is, why I'm in this position, and how much I'm making weekly while holding this current losing position. And if you like the sound of that, make sure you smash that like button and don't forget to subscribe, because I'm producing more and more content on how you can leverage options and more in particular the wheel strategy via selling options in terms of making passive income. And if you're brand new to options trading, there's a playlist down below which has all my option trading videos, how I trade options, and examples of me making passive income from anywhere from $500 to $1,000 weekly. So what we got here, we got a screenshot of a position in one of my larger accounts, and this is for ChargePoint Holdings. I'm not going to go into the reasons why I'm inside this position, but ChargePoint Holdings, they are a charging station company, and they've got charge points all across the US and across Europe as well. And they are one of the market leaders inside the US for charge point stations. Now, I'm very long-term bullish the EV market, and from my perspective, I think the EV market is going to be absolutely fantastic, and that is only going to be good news for ChargePoint, who already are the market leaders in the biggest, well, one of the biggest economies inside the world. So what we can see over here is that I own 2,000 shares of ChargePoint at a cost basis or an average price of $30. Now, that has costed me $60,000. And as you can see here, the current price of ChargePoint is $20.70. And if you work out the maths, that is a minus 31% unrealized loss, and that equates to 18.6k dollars. Now, that is a lot of money that I'm down. I'm down 31% inside this stock, and I'm doing well. I say I'm doing the wheel strategy. It's been a bit of a difficult time doing the wheel strategy on ChargePoint. But what I was doing, I sold puts when ChargePoint was above $30, and I had a strike price of 30, and I got assigned those shares, and it just continued to go down, and it's been down. And we'll look at the charts inside a second. So again, this is not a great position to be in. I would rather not be in this position. I don't think anyone would rather be in this position, but going back to, for those who watch my wheel strategy options videos, is if this does happen, and it will happen at some point if you are trading the wheel strategy, and for those who have been trading the wheel strategy, have been in this position at some point. It might not be to the extent of down by 18.5 grand, but either way, you've been assigned a stock that has dropped considerably. And the question I normally get asked is, what do you do in this position? How do you get out of this position? And that's what we're going to go through inside this video, while continuing to make money at the same time. So the first thing I want to do is just show you what the ChargePoint stock and where it's been and how's it kind of been going. And you can see over here that ChargePoint has had this massive ramp up to the end of 2020, and then most kind of growth stocks went all the way down during February to April, and then it kind of had this rampant move back up, and it was at this area around here back in June July time where the price was around this area. I think I sold a put at $30, and as you can see, I got assigned, and then it's continued to go across over there. And where ChargePoint is now, you can see back in March, had a lovely support area at $20, and price is now at $20.70. and again, it's consolidating at this area. So my hope is that we see a bounce at this area back, towards my kind of cost basis at $30. And what you'll also see here is that we've got this break even at 28.86, and what the break even is as I mentioned before, is I sold puts. So when I place this trade on to buy or I'm willing to buy 2,000 shares of ChargePoint at $30 at date of expiration, I received a credit for that amount. And again, that's the first stage of the kind of wheel strategy, is to collect that premium. Now that I've been assigned, what I've been doing and what I want to talk about in this video is I've been selling covered calls against my ChargePoint position. And I've received more and more premium for doing that. And what this is just showing me here is it's my cost basis minus all the premium I've received. So all the premium I've received, my break-even price is actually 28.86. So if ChargePoint gets back to 28.86, I could exit this trade, but I would give back all my premium, and I'll get obviously my $60,000 back, and therefore it will be a net neutral trade. I don't want to sell this position at break even. I just have it there, and I'll go into why I've got it there inside a second. So what do you do now when you're in this position and minus 31%? Now there's two things you can do. You can continue to sell puts, and what that means is that you're willing to buy more shares of ChargePoint at a strike price you decide to choose, and that's going to do two things. If you get assigned those shares, what it will do is bring down your cost basis, because obviously the more shares you buy at a lower price, this cost basis and break even as a result is going to reduce. The second thing is, if you don't get assigned, you're collecting more premium, which means you're getting more passive income. And what it also does is lowers your break even point, because you're collecting more premium, therefore bringing this break even down. That's the first thing. So because a lot of money is tied up in ChargePoint, my buying power, I don't have that much buying power left over. So I've got a few puts, like 2-3 contracts at 19.50, 19. But that's not going to reduce my cost basis that much, because uh, I've got the weight of my shares is more up here than it is down here. If I had another 60 grand to play with, unfortunately I don't. Then I would buy another 20 contracts, which would reduce my break even down to about 22, 23, whatever that may look like. So the first thing I'm doing is selling puts at the 1950 kind of mark, and if I did get assigned, my cost basis will reduce. But if I didn't get assigned, I'm still collecting that passive income, that premium, which again will lower my break even, so I just know where my break even is. But what I'm also doing now is selling covered calls. Now, selling covered calls basically is saying that I'm willing to sell, in this example, 2,000 shares of ChargePoint at X strike price by Y expiration. Now, the challenge people have is when the share price moves so far down, in my case 31% down, selling covered calls at your cost basis, you're pretty much not picking up any sort of premium. And what I've got here is I've got bar chart on at the moment, and what you'll see is you've got the strike prices, and this is, I like to do weekly options, and I'm shooting this video just before the market open on the 17th of September, so the next Friday is the 24th of September. So the current price is 20.70. My strike is at my cost basis is at 30. You can see here that the bid price is 2 cents, which basically means, so each contract, so I own 20 contracts, so 2,000 shares. That basically means I could place this trade and make $20, which is great. $20 is better than nothing. However, it's not that much money, and it's not going to lower my break even a lot more. So that's one strike price I could potentially do it at. and therefore if ChargePoint by next Friday gets the 30, I would then, come out of this trade and then get my 60 grand back, keep all the premium, and then move on to the to the next trade. The next thing I can do is sell at the strike above my break even. So in this case here, my break even is 28.86, and at the moment, the strikes for ChargePoint are in dollar increments. So I'll be looking to sell a covered call at the $29 strike. So that, for some strange reason, is showing one, but it'll be between like 1 and 2. But basically, it's the same amount. So at the moment, my break even is quite close to my current cost basis. That again, even selling it at break even is not there. And why would you want to sell it at break even if you're going to give away all your premium? Because the likelihood of ChargePoint by next Friday getting to 29 is, very unlikely. To get to 30, I'm 31% behind it, or in this case here as well, from the current price, around 40 odd percent. So it's not going to happen, which is why you're not picking up a lot of premium. So what I do, which you could argue is a bit more of a riskier strategy, is I'm using my technical analysis capabilities here and looking at where we currently are at this place. So if I was to draw this trend line here for ChargePoint, we're probably looking at something like this. Now, ChargePoint is at this resistance level, so we might get a bounce back over here. So what I want to do is sell a covered call that is not very likely. So even if I look at the sorry, this might if I get a horizontal line, they're at the 24. Let's call it the 25 strike. And let's make that color purple. So let's just say now that I wanted to sell a covered call expiring next Friday at $25. What would that get me in premium? So if we go to the $25, that will get me around 6 cents per share. So that is $6 per 100. So that is $120 in premium that I would get for holding this shares. And do I think personally, based on how things are going to ChargePoint, to get to $25 by next Friday? It's very unlikely. I don't know if Delta is on here. There's no Delta on this, so I can't see from a standard distribution perspective where it would be. But what I've been doing is basically selling covered calls below my cost basis and below my break even to collect more premium and putting it at such a safe distance that as long as there's no catalyst, no earnings has just finished. The next earnings isn't until not well, that's just last on 17th September. No, it's not. Oh, that's just the latest earnings. From that piece there. So they've just recently released earnings. There's not going to be any earnings anytime soon. Yes, we've got the bill around, the environmental bill from that piece, and that could potentially, if it goes good or bad, could spike ChargePoint up quite quickly. But I don't think anything's going to happen within the next week or so. So I'm happy to sell the $25 call. If I'm risk averse, I could do 1,000 shares at 25 and 1,000 shares at 26 to give myself some protection. Now, that's what I'm doing to get myself $120 weekly is still not a bad amount to be gaining. And again, that is passive income in my pocket, and also what it's doing, it's lowering that break even, because eventually when the break even gets to around 25, 26, I feel more comfortable selling calls at break even, and then as the price, I'm hoping the price gradually goes back up. As you can see, last time we were here, gradually went back up to this level. So then I can either sell out of the position before expiration, and then as the price starts to recover, the premium for these covered calls at my break even and at my cost basis will start to go higher. So then I can start selling again at my cost basis. So the only downside risk for this is kind of two things. One is that the option buyer, the person who bought this option for me, uh, can exercise that option at any point in time. So I'm in a covered call at the moment that is worth, I could buy it back now for like $1. I think it's at the 23 strike, and I picked up 12 cents per contract, per share. So that's $240 I've made this week in terms of selling covered calls. Now that buyer could exercise that option, and I will be forced to sell 2,000 shares at $23. Now that is way below my cost basis, and I would incur a loss for doing that trade. However, there is no point. It's very, very unlikely that this option buyer would exercise that option, because the current price is 20.70. Why would someone buy 2,000 shares at 23 um, when they can just buy the shares at $20.70? Doesn't really make any sense from that perspective. So it's very unlikely. The only times that might happen, unless it's a mistake, is if you've got dividends on dividend stocks. But this is not a dividend stock currently, so that is not really an option. It can happen. Um, I've heard stories of it happening, but at the moment it's not happened to me, and I've been in this position since like June. So I've been selling covered calls between the 30 and 23 for a number of weeks now, and I will continue to do this as time goes on. The second challenge could be if there is some positive catalyst and ChargePoint does rocket, and it gets close or above my kind of strike price. Now at that position, I'll be looking to roll the option, so buy that option back and then reopen a new option at a higher strike, hopefully maintaining a net credit. So I would buy it back, let's say for $100 per contract, and I'll sell a new one at $120 per contract, which will leave me with a net credit of $20 per thing, so to collect more premium. If I can't do that, and because it went absolutely parabolic, and now it's let's say I did sell the 25 and on Tuesday went to 26 because of some news, I would look to go take a loss on that trade. I might lose a grand or something like that. I've collected more than a grand in terms of premium and stuff, so I'm willing to lose a grand because I do not want to lose my shares at the 25 strike, because I'll lose more than that, and I'll make that grand back in premium as the share price kind of rises as part of that. That to me is something I'm willing to do on this trade, but I'm willing to take this risk to generate more money while I'm waiting for this stock to go down. Ideally, could have should have just waited until price got to here and start putting 20 contracts here. Whew, that would have been awesome. Because then I would have waited for that bounce and then picked up more capital appreciation on 2,000 shares. But I wanted to walk you through this particular example to show, look, there are options available where you can still make money. There are options available to you to be able to not only make more money, but also um, manage this position in reducing down your break even. If you're happy to give back your premium, and as this premium goes down, you can start selling cover calls at your break even price. And not everyone's going to be comfortable selling below their cost basis and break even like I am, but there isn't, and this always goes back to do it on a stock. I don't mind holding ChargePoint for the long term. For me, is I'm trying to trade the wheel and trying to get more premium, and I've locked 60 grand in, because if you think about it, I put 60 grand in to now make $100 to $200 a week, which is great, but I can make a lot more money with 60 grand than I can getting it tied up inside this. So it's not the best situation, but I'm doing what I can as part of it. So I really hope that this kind of makes sense to you. Again, click there's links around or end screen somewhere that will go into this in a lot more detail in terms of videos about the wheel strategy. I've got a wheel strategy segment that I do on Riot where I'm actually showing you weekly what I'm doing there, so you guys can check that one out. But I hope you guys found this video informative, and I shall see you guys in the next video.